Assalamualaikum warahmatullahi ta'ala wabarakatuh, and hello to all of you. This is Dr. Aisha, and in this video I'm going to explain about chapter 2, the retirement planning process, where in this chapter student must be able to establish retirement goals and objectives, gather data relating to retirement planning, and analyzing data to determine client situation and his retirement needs. The student also should be able to design and recommending the retirement plan, implementing the retirement plan, as well as monitoring performance and reviewing the retirement plan. This is the process of retirement planning, and it comprises of 6 steps. Number 1 is about establishing retirement goals and objectives, gathering data relating to retirement planning, analyzing data to determine client situation and his retirement needs. Step 4 is about designing and recommending a retirement plan. Step 5, we're going to look at the implementing the retirement plan. And step 6 is about monitoring performance and reviewing the retirement plan. We're going to look at all of these steps in detail in the later part of this video. Step 1 is about setting the retirement goals and objective. And in this instance, it is important for us, the financial planner, to understand the client's actual situation, in the sense that we have to know what is client's needs or aspiration, goals and objectives during retirement period. And it is also important for a financial planner to gather both qualitative and quantitative assumptions when the financial planner is about to prepare the financial planning for the retirement. This qualitative assumption includes the subjective assumptions. For example, like the lifestyle during retirement, the choice of residency environment, where is the location for the retiree to stay after the retirement, for example, pursuits and post-retirement employment issues. And quantitative assumptions includes other information such as the inflation rate, the selected retirement age, at what age they plan to start to retire, the years to retirement, how long they want to stay in the retirement period, or they plan to be in the retirement planning process that they want to prepare, income tax return, and some other information that are quantitative in nature. The key planning issues is about the retirement income need. And income at retirement is the most important issues for us to solve in the retirement planning. And in order for us to identify the retirement income need, we can refer to the replacement ratio method or the expense method that we are going to discuss after this. Planning for retirement will require a planner to consider several variables affecting the client. For example, like the retirement age, what age you want to retire, expected mortality of the client, means that how long that you will live your life. This is something very difficult because we are not sure at what age we will die. The income needed at retirement, the resources available at the retirement to provide the income, the adequacy of the resources at retirement, as well as the amount of savings to fill any deficiency if the resources are inadequate. In order for us to decide on the retirement age, let's have a look at the timeline on retirement planning. As we can see here, at this diagram, as you can see, this is the present age. And this is where the life ends. And here in the middle of the graph is the retirement age, which means during the current age or the present age, till the retirement age is actually the accumulation phase. Means that the client can accumulate money or resources for the retirement. And once the clients reach the retirement age, the difference between retirement age and the life ends is actually the consumption phase, where the clients no longer have an active income and depends on the saving or resources that has been accumulated during accumulation phase. Okay, so for instance, if the target retirement age of the client is 60, let's say here the age of the retirement is 60, and the present age of the client is 40, for example, let's say the present age is 40, therefore, the accumulation phase is about 20 years, which means the gap between 40 to 60 years means that the client has around 20 years to accumulate the resources for the preparation of the retirement age. Another things that is important for students to understand is where we have to identify the years of the life ends. Let's say the client agreed that the life ends at the age of 85, for example. Therefore, the consumption phase is 60. Here, 85 minus 60, and we can get here the consumption phase is equivalent to 25 years. Means that the life end of 85 minus the retirement age of 60, then we can get here 25. And this is very subjective. Let's say the client live longer than that, then surely the consumption phase is much higher. Another things for me to explain is about here at this point is actually referring to X, where it is referring to the current or existing resources owned by the clients. For example, let's say the client has EPF worth 100k as well as the unit trust worth 100k. And at this point of time, that is Y, here in Y, the resources for retirement, that the EPF and the unit trust will be forwarded, or we will calculate the future value of the EPF or unit trust, because this is the value at the peak of the retirement age, where the EPF and unit trust will increase in value, and that particular resources will be used to cover during the consumption phase of a retiree. Beside that, it is also important for me to note that this kind of concept is applied in capital liquidation approach, where all of the resources are considered as finished, as considered as gone, finished, when client reach 85. Means that the clients will not be able to pass the resources to the siblings or to their kids or children of their own. Determining the client's retirement-related objectives. The objectives must be purposeful to the client's life, and the list of the objectives that are common to retirement planning are basically first to arrange the client's finances so that when he retires, there will be more income generating asset to spawn sufficient income. So this is a part of the responsibility of the financial planner, where once we discuss with our clients about their retirement objectives, this is also something that we need to encompass to our discussion, where the aim is basically to have our client to be income generating. I mean that to make sure that the clients have enough or sufficient fund for them to cater for their expenses during the retirement period. Other things, which includes how we can preserve the asset that has been accumulated for us to earn a rate of return that will protect clients' purchasing power. The third one is to invest in a manner that is aligned with the risk profile of the clients, because later on we're going to look at the risk profile of the client, whether the client is risk taker or risk averse, and this will surely affect the investment that we are going to suggest to the client. Other than that is to ensure that there is a sufficient liquidity to meet the expected and unexpected needs, to ensure that the accumulation of to meet future needs do not unduly affect current lifestyle. For example, if we suggest for the clients to make a huge of saving now in order for them to save for their retirement, that might not be rational, in the sense that client might feel it is too burden for them. Thus, later on, the planning might not happen as we plan. Other than that is to design a plan that guides purchase of investment with respect to its time horizon, holding period, and sale that matches retirement needs, as well as to maximize the after-tax returns of investments that we targeted for the purpose of retirement. Step 2 is about gathering data relevant to retirement planning, and the most important data to be collected is the data related to the retirement goal of the clients, and it is important to identify whether client wants to use capital liquidation or capital conservation. And we're going to look at both later on, as well as to determine the appropriate time and value for data gathering. In step 3, it is where we have to analyze data to determine the client's situation and his retirement needs. For example, some of the client's non-financial needs includes overcoming the loss of identity syndrome, where the CEO yesterday will be nobody today. And this is something, some kind of lack of loss of identity for someone to suddenly lose the position and the power and influence, and it is a part of the needs that the clients also need to understand. Other than that is about health consideration, because it is very common for us to see someone who is, once they reach old age, it seems that their health also will be reduce and subject to certain disease, unfortunately. The next important point to consider is about the relationship between husband and wife. If there is some kind of smell of divorce, so this is also something that we need to consider. Other than that, we also need to look at where the client expects to live after retirement, whether it is still in the house at the town, or they want to move at the rural area where they want to build a specific house for that purpose, as well as the pre and post retirement interests, where like someone who reach old age, they possibly try to develop new hobby, like planting pokok durian, or they live to go fishing or spend time with their grandchildren. So these are among of the activities that we have to know. And sometimes people, they have planned to travel all over the world, and this is actually very costly and also need to be taken into the consideration or the financial planning itself. Here is about determining and filing the client's retirement needs, and it involves 6 stages. Number 1 is about we have to determine the first year income needed at retirement. Stage 2, determining the required capital or lump sum required at the retirement fund, with or without residue for distribution during retirement period. Stage 3 is about determining the current and future resources destined for retirement purpose. Stage 4, converting the value of the current resources to the value at the retirement. Stage 5, finding the lump sum retirement gap or the deficit or surplus amount. And the stage 6, that will be the final stage, is determining the funding needs during the pre-retirement period to meet the sum needs at the retirement. Stage 1 is about determining the first year income needed at the retirement. So at this point of time, it is important for us to capture all the essential assumptions needed to compute accurately the retirement needs of the clients. Alright, so we can use replacement ratio method. Okay, in this method, basically it based on the assumption that changes in the cost of living will be roughly echoed by changes in the individual income over the years of his working life. Which means we can estimate the percentage of the income needed based on the pre-retirement income. And in this replacement ratio method, it is based on the standard of living that currently enjoyed by the client. That is the standard of living during the pre-retirement period. Therefore, if it is closer for individual to reach the age of the retirement, will be much easier to identify the desired income that the customers or the clients need during the retirement. In regards to the replacement ratio method, normally the experts suggest the percentage of the income needed of the retirement is about 70 to 90% from the client's last drawn salary. And this is because when someone actually starts to retire, certain expenses will be eliminated or expected to reduce. For example, let's say someone no longer work, therefore the traveling costs, for example, from home to the working place, will not happen anymore. Or other costs, for example, like lunch in office or breakfast in office, this cost also will no longer occur in future. So that's why the cost will be or expected to be reduced by 70 to 90%, and it much depends on the discussion or the agreement between the client as well as the financial planner. For example, Mr. Hafiz, with the age of 30, is currently earning 100,000 annually and expected to retire at the age of 55. He estimated that his retirement income need for the first year is 80% of his last drawn salary. His salary increment is assumed to grow at the same rate of the inflation rate, that is 4%. Therefore, in this case, years to the retirement is 55 minus 30. Okay, 55 is the retirement age minus the current age, that is 30, which means the years to retirement is 25 years. So Mr. Hafiz still has another 25 years for the accumulation, and it is assumed that the inflation rate equal to assumed salary growth rate, that is 4%. Therefore, the formula that we need to use is the future value formula, FB equal to PV 1 plus R the power of N. So the PV is 100,000 times with 1 plus 0.04, that is this 4%, we change to decimal, the N is 25. So we solve for this part, so we can get 2.66584, and the total is 266,584.00. Okay, so this is actually the amount, the future value amount of the current earning of Mr. Hafiz by taking into account the inflation rate as well as the growth rate of 4%. As in this case, we know that the first year income need is about 80% of the last drawn salary. Therefore, we will take only 80% from this figure. So 80% times 266,584, which means that this is the retirement income need for the first year, that is 213,267 for Mr. Hafiz. You can use the financial calculator to calculate for this formula. In this instant, you go to your financial calculator, 0, okay, you on it, you on the calculator first, and then if you look at this formula, 100,000 times with, in bracket 1 plus 0.04 and the power of 25, okay, therefore 100,000 times with, you make a column like this, 1.04, close the column, and you go to shift shift 6, okay, for us to set for the power. Now the power is 25, okay, 1.04, we have this set, you go to shift 6, then you can get this and the power of 25, and you execute, and you can see here 266,584 266583. Okay. So that will be the answer for this. It already solved, and you can see 266583, and it is, like very closely to the answer given here, that is 266584. Here 266583.63, and of course if you round it, then you can get 266584. Besides using this formula, you can also use calculator for you to get the answer for this calculation. On your financial calculator, you turn on and you choose CMPD, which is about compound interest. Set for begin, because this payment is likely to be made at the beginning of the year or at the beginning of the month, because it is a yearly expenses, so we consider it as a payment that should be made at the beginning of the term. So set begin, and the N is 25, the I is 4, you just type 4, the PV is 100,000, you include the PV 100,000, the PMT is 0. Okay, so we want to know the future value for this 100,000. The PY is 1, the CY is 1, the FV is you're going to solve for that, and you can get 266583.633. What if the inflation is higher than the income growth rate? So in this instance, growth element must be included in the calculation of the client final salary. So let's say the growth is 2%, thus the amount needed during the retirement will be, so this will be the new formula for future value, where we will incorporate the growth. Okay, so by using this formula, we try to solve, and you will get this figure if you solve this formula, that is 437,359. So in this case, the growth element is 2%, therefore we can see it is higher, this future value is higher than the first calculation that we just completed, where we can see that without considering the growth element, the amount needed for the first year of the retirement is just 213,267. But as in this case, we can see that the inflation rate is higher than the income growth rate, therefore the first year retirement income also higher or increase up to 437,359. And if we take 80% out of this, the amount here is 349,887. It is where we already included the inflation in our calculation. Beside of replacement ratio method, we can also use the expense method for us to identify the first year retirement income. And in this expense method, we have to construct the budget for the post-retirement living, and it involves estimating the amount that would be needed to meet the cost of housing, clothing, food, transportation, medical expenses, and etc. And we can use this expense method worksheet to come up with a specific expenses that need to be covered during the retirement phase. As in this worksheet, we can see the item like housing, food, transportation, cloth, care, medical and recreational, professional development, insurance, saving, and many others that possibly suitable for our consideration in determining the client's expenses. And it should be very detailed, and we also need to assume the rate of inflation and also calculate the future value of the expenses for us to know the specific amount of the first year retirement income by using the expense method. Now we are in stage 2, where we are going to determine the required retirement capital or lump sum required, and in this case we can use capital liquidation method, where in this capital liquidation method the lump sum required refers to the total amount of fund that we are required to meet the yearly retirement income for the number of years during retirement phase, which means if the retirement period is 30 years, at the end of 30 years there will be the balance of the retirement fund will be 0, which means there will be no money left either for us or for our children. So which means if the client can live for another 30 years from the date he retire, the lump sum of money, the retirement fund that we set must be able to cater for that particular 30 years only. I'll give you an example of capital liquidation without inflation. In this case, Mr. Ali decided to adopt a capital liquidation approach in retirement planning, and below are some variables and assumptions in Mr. Ali's retirement planning. And here is basically the information given to you. The first year annual retirement income is set to be 100,000. The rate of return in retirement is 5%. Number of years expected in the retirement phase is 20 years, and the inflation rate is 0%. And this is actually the formula for capital liquidation method. Alright, so this is the formula, and during exam all of the formula will be given to you, especially during the professional exam. Okay, so what actually means by this formula? The PV means the lump sum required for retirement. This is what we want to get basically. A is actually the first year annual retirement income. This is the payment that should be paid to the retiree each year. The rate of return of retirement account is the return from the saving or the return from the retirement fund is about 5%, and number of years in the retirement phase is 20 years, as in this case of Mr. Ali. Therefore, if we apply this formula, okay, and we include all of this number, then we can get here 1308510. And you can also use your financial calculator to solve for this. You set begin, and it's 20i equal to 5. PV is actually the one that you are going to solve. PMT is 100,000, future value is 0, PY and CY is 1. Okay, compounding is 1 in a year. Okay, and the payment per year is just 1. PY means that the payment made in a year is just once, and the compounding per year is also 1. Okay, so once you solve, you go to PV and you solve this information, then you can get this figure, which is quite close to the one in this answer. If you check the answer here, 1308532, and the answer that you use the formula 1308510, there's a slight differences. Okay, a slight difference between these two answer. However, this is particularly very normal, where the answer from the formula and calculator just a little bit different, so it is considered as accepted. Okay, so because calculator normally consider decimal in a serious way compared to the formula, so that's why we can see here is a little bit higher, but in the exam both answers are accepted. And if we want to prove whether this answer is correct, in the sense that at the end of the 20 years the balance of this fund should be 0, so we can look at the calculation. Okay, so this is actually the worksheet from our calculation before. As for year 1, you can see the beginning balance is 1308532, and this is similar to the one from our calculation using calculator. And the annual usage is 100,000. So over 20 years, the annual usage is similar. This is what we call as, in the example, there is no inflation, where every year the annual usage will be fixed at this amount. And in this column is about the return, because this amount of money, the retirement fund that we have accumulated, this will be invested in any instrument with rate of return of 5% as given to you, the information here. Okay, the rate of return on the retirement is 5%, and here basically the ending balance. Therefore, I would like to explain to you the first row from this table. Okay, so the beginning balance is 1308532. By taking the annual usage of 1308532, because this amount you have to take at the beginning of the year, because this is expenses. Okay, you're going to use that on that particular year. Therefore, this one, beginning balance, minus with 100,000, then we can get 1208532. Okay, 1208532 minus with 100,000, then we can get 1208532. In order for us to calculate the return, we have to take 5% out of this 1208532. Then we can get here 60426.6. Where if you round the figure, you can get 60,427. And if you add this return with the remaining of the balance, 1208532 add with 60,427, then you can get the ending balance of 1268959. So this is how you can actually understand how the movement of the money in the retirement fund itself, from the beginning balance to the payment per year, as well as by taking into account the return rate of return, as well as what will be the ending balance for the first year. And if you move forward with the same understanding at the end of the 20th year, you can see that, okay, here the ending balance is 0, which means after 20 years, this is the capital liquidation approach that we use. So at the end of 20 years, there is no money left in the account. In stage 3, we have to determine the current and future resources earmarked for the retirement purpose. In this instance, we have to identify current available assets or savings or investments which are planned to be used for the purpose of retirement. Our clients might have some personal asset, for example, like home, that they want to use during retirement, or sometimes they have cars that they want to use during retirement. So all of these assets, the home, the cars that they want to use for the personal consumption, should not be included in the preparation of the list of assets or cash for the purpose of retirement. This is because we only identify the assets or cash savings which is intended to be used during retirement only. So if it is just for personal use, then it's not going to be accounted for the retirement purpose. Let's say your client intended to sell his second home to cover for the cost of living during retirement. Therefore, this second home will be included in the calculation of available resources at the retirement. So, which means this particular asset is marked, is intended to cover the cost of living during retirement. If, for example, your client have several cars, and that particular cars will be sold once they reach retirement because they want to use the cash from the sale of the car to cover for the retirement expenses, then it also can be considered as an asset that can be used for the purpose of retirement. In stage 4, we are going to convert the value of the current resources to the values at the retirement. The current resources mean for retirement are converted to resources at retirement using time value of money technique. This is quite simple. And the total amount derived is the fund or resources available at the retirement. Sometimes this is also something we call it as retirement resource status of the client. In order for us to convert the value of the current resources to the value at the retirement, we have to consider the current available resources for retirement as well as the future resources of existing accumulation plans for retirement, which means we will take into account the current available resources that has been set for the retirement as well as the future resources that also has been set for the retirement purpose. Alright, so in this instance, planner must be conservative in determining the values. Okay, so once you want to set or you want to calculate the value, because at the end of the year, at the end of the terms, at the end of the calculation, we have to evaluate the value using the future value by taking into account the value at the retirement. Therefore, in this instance, conservative is important in the sense that you must not predict the price to be or the value to be too high until it is misleading. Okay, so this is not acceptable. If you predict that the value will be increased too high, it might be misleading and it will be meaningful at the end of the day, because that's why you have to be conservative. You also should not put a value that might be too low, okay, and it might not reflect the economic value of the asset. So it is just somewhere like in the middle, in the sense that it must be not too high and also not be too low. And the rate of return must be derived from the fact-finding sheet, something that you already agreed between your clients. And as we say before, this rate of return should be, like very logical, and it represents the current economic value, and should not also be too high or too low. And as we should take into account that it also should be accurate. Okay, so I give you an example of computation and the resources for retirement here. For example, let's say the clients, they have stocks and shares with an existing value of 150,000. Let's say the return is 10%, so it is quite okay, it's quite modest, it's quite logical. And the years to retirement is 15 years, as in this example. Therefore, the future value is 62587. Okay? And unit trust, 150,000, 8%, 15, and this figure is same goes to EPF, because this is current available resources. So the client should look at the current balance of the EPF, and we have to calculate the value at the retirement, the future value of the retirement. Therefore, okay, you can get this figure, and the total value at the retirement is 1429010, and this actually represent the current available resources of the client. You can check this figure using calculator, okay, and you set N, okay, N is equivalent to 15 years, I equivalent to 10, for example. In the case of stock and shares return, I equal to 10. The PV is obviously 150,000. The FV is the one that you are going to solve. Okay, PMT is 0, PY 1, and CY equal to 1. And you solve the FV, and you can get here 626,587. Okay, so the similar procedure also applied to other resources for retirement. If you look at this calculation using a calculator, you can see that here I choose N as a set for the CMPD calculation. Why it should be, like N? Why it is not a beginning? You should understand that all of this return, you can only get the return at the end of the term. For example, like unit trust, you can get this return after you invest after 1 year. So at the end of 1 year, only then you can get this return. So that's why we set here N, not begin. Alright, just now we already have a look at the current available resources for retirement. Okay, this is the text before, where you can see here we have stock, unit trust, EPF. So this is the current EPF available for retirement. Now we move to the second part of the available resources for retirement, where we're going to look at the future resources of existing accumulation plans for retirement. So the existing accumulation plan refers to those plans that the client has committed to accumulate its retirement fund on a regular basis. Okay? Example are EPF, unit trust, endowment plan for retirement, and fixed deposit with bank. And future value of all of these instruments should be determined using the time value of money. So in regards to EPF, for example, we have to compute the FV of its existing balance. This is what we did here in the current available resources or existing resources. Okay, where EPF here, we already compute the existing value and we already calculate the future value of the EPF in this of the current EPF or the existing EPF, that is 326,598. Okay, so now because we are going to calculate the future resources of the existing accumulation plan, which means we're going to look at the future EPF because we're going to contribute more later on in the future, as well as if, for example, your clients, they have another investment or saving, for example, let's say unit trust, where they did it in future, they will do it in future, for example. So this is something we have to take into account. Give you the example here. I give you the example here. Mr. Ahmad has a plans to invest fixed sum of 5,000 per year. Okay, so your client has planned to invest fixed sum 5,000 per year. So every year 5,000, 5,000, 5,000 will be paid into this a unit trust fund, and 15,000 into EPF, and the EPF contribution is increased at 5% per annum. Therefore, in this instance, let us calculate for the fixed sum of 5,000 per year, the investment that will be made to the unit trust. So if you look at this FV of the annuities for us to calculate the unit trust, what will be the future value of the unit trust once you reach the retirement? The computation of an accumulation plan where annual contribution is fixed, like the unit trust fund, and in this case we can use this formula. FV equal to PMT times 1 plus R power of N minus 1 divided with R. Okay, so we can use this formula where if you look at this formula, FV is actually the future value of the unit trust that we want to calculate. The PMT is actually the fixed annual contribution that will be made every year by Mr. Rahmat. The rate of return, and N is actually referring to the number of years to retirement. So let's say we make an assumption that number of years to retirement for Mr. Rahmat is 15 years. The I is 8%. The PMT, the payment every year, because it has been stated here that Mr. Rahmat planned to invest sum of 15,000 per year into a unit trust fund. Thus, the payment every year will be 5,000. And if we use this formula, okay, that I have shown you before, all right, by taking an assumption that the investment starts immediately, okay, at the beginning of the year, so we can see this is the value that we can get. So after 15 years, and Mr. Rahmat consistently invest 5,000 per year in this unit trust, and after 15 years we can get 146,621. Alright, besides of using the formula, you can also use financial calculator to derive this value, where in your financial calculator CMPD, okay, you go to CMPD and you set begin. Why it is begin? Because we assume that the investment start immediately, or if the question say that we assume that the payment made at the beginning of the year, so we choose set here as begin, and it's 15, I equal to 8, PMT 5,000 per year that will be made. CYPY is both 1, and if you go to FV, you solve for FV, you can get here 146,621, similar to the answer once we use our formula. Okay, so in that case, this answer is where the question say that the payment made immediately, or sometimes they say that the payment made at the beginning of the year, for example. Nevertheless, if Mr. Rahmat invests in the unit trust at the end of the year, then the formula will be a bit different. Okay, so here is the formula. Okay, so by taking into assumption that the accumulation start at the end of the year, therefore the value will be lower, that is 135,760, which is lower than the first one that we assume immediately or at the beginning of the year, that is 146,621. And if you want to prove this using your financial calculator, all of these figures are similar, except for the set here, you change from begin to the end. So once you change the set here from begin to end, and all other figures are consistent, then you can get this figure 135,760. Alright, so just now we already discussed about the FV of annuities of the fixed contribution like EPF, like unit trust, where every year the payment made will be 5,000. But now we're going to look at the case of FV of growing annuities in the case of future EPF. Because unlike the first one, where the contribution is fixed every year, means that the first year is 5,000, the second year is 5,000, the third year also similar 5,000 in the case of unit trust. Nevertheless, for future EPF, the situation will be different. Let's say the first year the contribution is 15,000, the second year it might be an increase. Because as you know, the EPF, okay, the contribution will be varied, will be different according to the salary of the particular client. Therefore, during the second year, must be some growing or addition. And during the third year, this 15,000 must be some, like there will be an increase, not just simply 15,000, but there will be an increase of their contribution each year. Therefore, in this case of future value of growing annuities, where the accumulation plan, where the annual contribution is increased at a constant rate like EPF based on the average growth rate of the wages, okay, because once your salary increase, the EPF contributions also will be increased. Therefore, the formula here is different. This is for growing annuities like EPF, where if you look at this formula, the PMT is the first year contribution, the R is the rate of return, the G is the constant rate of growth in contribution, which means there is a growth in the contribution. So let's say if we assume that the payment is 15,000, there will be a growth on this contribution per year, and N is the number of years to retirement. Therefore, if you assume that the payment is 15,000 per year, as in the question given to us in the case of Mr. Rahmat. Okay, so if you look at this question, Mr. Rahmat has planned to invest fixed sum of 5,000 per year into unit trust and 15,000 into EPF. Therefore, as in this case, PMT is 15,000. R, let's say we assume is rate of return is 5%. The growth of the constant rate growth in contribution is 4%. The N is 15 years. Okay, therefore, and let's say we make an assumption that the first contribution start at the end of the year, EPF, because it is very logical. In regards to EPF, we have to work first, and after we earn the salary at the end of the term, only then we can have an EPF contribution. Okay, so use this formula that has been given to you before. Okay, you have to apply this formula and you have to do the calculation, and at the end of the this formula you can get the future value amount, that is 416,977. Therefore, the total future value of future contribution, which includes this one is the future EPF, and this one is actually the unit trust, 146. Okay, we get the, alright, it's from here, 146621. This is from unit trust. Alright, so the total here is 563,598. Okay, so this is actually the resources from the future resources. Okay, that is from future EPF and the future unit trust. So if we want to calculate the overall, okay, overall resources for retirement, overall resources, that total resources that has been dedicated for the purpose of retirement, we have to add the current available resources for retirement here, that is 1429010. Okay, add this value together with this future EPF and unit trust, and we can get here the future value of resources available at the retirement, that is 1,992,608. Now, once we identify the existing and future resources for retirement, we have to prepare a worksheet like this for your client, where we have to incorporate both existing and future resources of the client, and we can see here basically the detail of the information, and the total is 1,992,608, similar to our calculation before. We are now in stage 5, where we want to find the lump sum retirement gap or deficit or surplus amount. And in this analysis, we are going to calculate the retirement gap, whether it is a deficit or surplus, by comparing the lump sum needed at a retirement with the retirement resource status RRS that we have calculated before. And if we look at the example based on our earlier calculation, the lump sum needed at the retirement, for example, is 1,308,510, and where basically we find this figure. If you remember the calculation on the capital liquidation method that we already discussed before, where we set that the payment per year is 100,000. Okay, and once we calculate using the formula, we can see that the total of income or the capital liquidation or the lump sum needed for the purpose of retirement using capital liquidation method is 1308510. Okay, and here is basically the proof of the calculation that I've already explained to you before. Okay, where using capital liquidation method at the end of the year, at the end of 20 years, then the balance is 0. Okay, so that's how we can get the lump sum needed at the retirement, that is 1308510. And we compare this with the retirement resource status, okay, RRS, in the previous document. You can see this is the existing value of the retirement and the future value of the future resources at the retirement, and the total is 1992608, which means once they reach the retirement, okay, the lump sum needed at the retirement is about 1.3 million, but the resources is much higher than that, that is 1.9 million. As in this case, we call it as a surplus because the RRS is higher than the lump sum needed at the retirement. Nevertheless, if this value, the lump sum needed, is higher than the RRS, then we can get what we call is as a deficit. And this is the deficit or the shortfall that we have to cater. Nevertheless, okay, let's say we take into consideration, let's say, because as in this case the situation is a surplus, but in a case that lump sum needed is about 2.1 million, then the retirement gap will exist here, where 2100000 minus with 1992608, then we can have here 107392 of the retirement gap. Okay, and it is deficit. Okay, so next we are going to look at on how we should cater for this retirement gap, or should we take into account this shortfall in our retirement planning action. Alright, now we are in stage 6, where we want to cater for the shortfall during stage 5, or the retirement gap that exists during stage 5, where there is a retirement gap or deficit of 107392. This is a situation where the lump sum needed is higher than the retirement resource status or RRS. Therefore, in order to cater for this shortfall, we can use 3 ways. It's either regular funding approach, or lump sum funding approach, or combination funding approach, which means we can solve for this 107,392, the shortfall, by using this method. Is either we make a regular saving by annually, for example, or by monthly, for example, or we can also prepare a lump sum funding now, or we can use a combination between regular and lump sum funding. I give you an example here for regular funding approach, where we will make a saving regularly, it's either annually or monthly. And in this part, this is basically the formula, because we want to identify the payment that the clients have to make annually or monthly in order to prepare for this 107397. Therefore, we want to identify the payment. This is the formula, and the RG is this is the payment that we want to know. RG is the retirement gap, and this is the information given to you. And is in our case, the retirement gap is 107392. Number of years to retirement is 15. Rate of return is 15. Therefore, the regular annual contribution is 4740. Okay, by using the formula that has been given to you here. Okay, so annually, this client have to make a saving annually 4740 every year for 15 years, and after he will be able to cater for the retirement gap of 107392. The first situation is where the payment should be made yearly, but if we want to change the payment to monthly, we can calculate the N by where we have to times 15 years with 12, so that we can get 180 months. Okay, so this is for monthly funding. We set the calculator as begin. N is 180, I is 0.4166, where that 5% is actually for 1 year. We have to divide with 12 months so that we can get 0.4166. The PV is 0. The future value is 107392. This is the future value that we want. And the PY and CY is also 1. And once we solve for the PMT or the payment, we can get here 400. That is the amount of monthly payment that the client should make for 180 months, okay, in order to get the future value of 107392. Now we are looking at lump sum funding need approach, and this approach involves finding the present value of the retirement gap based on the selected rate of return and the number of years to retirement. The formula is PV equal to FV divided with 1 plus R to the power of N, where the PV is lump sum funding required for today. FV is the value of the retirement gap at the retirement age. R is rate of return of the investment, and N is number of years. Based on information given to us before, let's say N is 15, R equal to 5%, and the FB is 107392. If we apply to this formula, we can easily get 51,657. So this is the value of the money today. If we want to have 107,392 in for the next 15 years, okay, so the value of the amount today is 51,687. So in case the client would like to have this lump sum funding, which means that if the client able to come up with 51,657 today, this amount will be able to cater for the shortfall of 107,392 at the age of the retirement, that is another 15 years. So sometimes the clients might, suddenly get the cash from unexpected sources. For example, let's say if they have possibly friends give them money, or those someone close to them suddenly give them money. So that's kind of money is unexpected. Basically, it's a gift, for example, as a present for their wedding, for example. So that particular money is it is rare to receive that kind of money, but it can happen. So if in that particular case, if the client's able to raise this value or this amount now, and that money will be invested in a instrument which will bring the rate of return of 5%, and in the next 15 years, obviously we can have this 107,392 of the shortfall we can cover for this course by the end, or once they reach the retirement age. Besides of using the formula, we can also use financial calculator to come up with this figure. So you set the begin for this lump sum funding need, and it's 15, I equal to 5, and present value is the figure that we want. Actually, this is for the solve. PMT is 0. The future value is 107,392. CY and PY both 1, 1. So you go to the PV, you solve this value, and you can get 51,657. The third method is a combination funding approach, where we can have the sum of present value money today plus the funding for contribution of monthly payment for certain number of years or certain number of months. Let's say the client can contribute a lump sum of 10,000 immediately. Possibly the client got a bonus, or not sure where is the resources or source of this income, but let's say client at this point of time, they able to have a lump sum of 10,000 immediately. Therefore, amount that he needs to contribute monthly, in this case he wants to contribute by monthly, okay, to fill the gap of 107,392, which means, alright, we can use calculator for this purpose. Set your calculator for begin, and it's 180 because it is monthly. Okay, 15 years times with 12 months. And I here is where you have to divide 5% with 12 months so that you can get here 0.4166. The PV is negative 10,000, where this is the amount of cash that are available now that clients have at this point of time. And the FV is 107,392. This is the desired figure that we want once the client reach the retirement age. The PY and CY both 1 and 1. This is where you go to the PMT and solve for this information, and you can get 321,395. This is similar, this is the figure, the monthly figure, the payment that should be made by the client once they have that 10,000 at this point of time. So for the next 118 months, the client must make a payment of 321,395 over these 15 years. Now we are in step 4, that is in the phase of designing and recommending a retirement plan. And at this stage, the planner can start to construct the work on the retirement plan, and at the same time have to make sure that all of this information are always at the back of the head of the planner at all the times once they want to construct the retirement plan. For example, what does the client want at the retirement? What are the client financial retirement resources? What is the income needed to sufficiently fund the lifestyle that has been chosen by the client? What is the additional lump sum amount needed? Fund deficiency to fill up the client's retirement need. What must the client do from now on in order to meet his retirement funding shortfall? So all of this information we actually discovered before in the previous steps, but in the planning or constructing the retirement plan, all of this information must be at the back of the head of the financial planner at all the times to make sure that the construction of the planning is tally with the needs, with the aspiration, with the goals that has been discussed with the client before. The planner also need to know about laws and regulation that would be helpful in determining the design of the retirement plan, for example. So let's say the clients currently has a life insurance, so it is important to give an advice to the client because that particular payment for the life insurance is basically qualify for the tax deduction. Another important things in this step is about disclaimers and disclosures, because in order to protect the planner and the organization, it is important to include proper disclaimer and disclosure statement in the financial planning itself. This is the document about, or the information about disclaimers and disclosures is a must in the retirement planning report of the client. And that particular disclaimers, basically it means that it is the statement that allow the planner to renounce certain areas of responsibility that are outside his control when the plan is implemented. So this is in order to protect the planner and the organization themselves, where like the disclaimers and disclosures should be included in the financial planning report of the client. Step 5 is about implementing the retirement plan. It is where the financial planner must include the letter of authority of act in the financial planning report. And this is because it is important to get the permission of the clients, or the permission of the clients is actually recorded in black and white, and the client signs the authorization document in the letter of authority of act. Usually, the permission is granted via a letter of authority to act from the client. And in the letter of authority itself, it basically covers several important points, which includes that the client actually understood about the retirement plan that has been presented to him or her, and the plan and the assumptions used in the construction of the plan basically reflect the current situation of the client, and the client basically understands the implications of the disclosures and disclaimers stated in the plan, as well as the client is fully informed about the fees or charges and commission involved, in what manner each professional in the team is compensated when the plan is progressively implemented. So it is want to protect the client as well, that they actually understand the content of the report, and they know the implications of all of this planning, as well as they are well informed about the fees and charge on them. This will be the last step in the retirement planning process, which is step 6, monitoring performance and reviewing retirement plan. In these steps, it focuses on 3 main monitoring types. Number 1 is monitoring the investment performance. Number 2 is review of the investment. And number 3 is scheduling the review session. Monitoring investment performance means that the planner have to monitor changes in the environment or laws and regulations and other factors that may give an influence towards the performance of the client investment. Review of the investments here includes checking the performance of the investment in the portfolio and reporting them to the client, checking the relevancy of the investment in meeting retirement goals, revise the earlier projection to ensure it reflects the current situation, as well as the manifestation of new instruments that may be better than the current ones for meeting the objective of the client. Therefore, from time to time, the financial planner must update their knowledge, because sometimes there's a new instrument in the market that might be very helpful or very useful to be used by the clients to improve their performance or their financial performance or financial condition. So this is a part of the checkings that need to be done by the financial planner. The last one is about scheduling the review session, where the financial planner must also review the financial planning that has been made before, and it is can be divided into 3 parts. The first one is initial review, which will take basically about 1 month after the strategies outlined in the plans are implemented. That is initial review. This is to make sure that the performance of the investment and other non-investment activities are basically tally with the expectation, are in alignment with the goals and objective that has been set. Number 2 is yearly review. That is basically 12 months after the plan has been implemented, and this 12 months review need to be made every year. Like every year, once in a year, they have to the financial planner must make a review again and again on the financial planning report to make sure that the performance of the investment are as per expected, or in case something new happen, or in case there is a possibly new instrument in the market that they want to suggest. So during this review, all of these changes can be made. Impromptu reviews, and these are reviews that are triggered by unexpected events, or where the client's requisition for one because he suddenly feels that he want to change the plan with regard to issues concerning his retirement. For example, let's say suddenly we have a financial crisis, so it will affect the value of the property, or he changed his mind, possibly he wants to buy another property, or possibly he wants to sell the current property that he has, or possibly due to unexpected event, death of the wife, for example, death of the family members, or divorce. Things like that might lead to the impromptu reviews, or the demand or unexpected event, the triggered by unexpected events or situation that might lead for another review by the financial planner.